Welcome everybody. Good morning or good afternoon, wherever you're joining us today. Today we have in our 18th edition of the CVC Insider, brought to you by 500 Startups. We have a very exciting session with Malin Carlström, Head of Ventures at ABB Technology Ventures, who prior to joining ABB spent 13 years as an investor in the Nordic venture capital market, and we'll be sharing more about her unique journey. But before we get started, just wanted to give you, set the tone, set the stage, and give you some context. First of all, my name is Alba. I'm part of 500 Startups. 500, we are one of the world's most active early stage investor with over 2,500 investments into 75 countries. And at 500, I lead our global innovation strategy practice, working closely with corporate innovators to power their own innovation initiatives, partnerships, and investment into startups. And about 5 years, 6 months ago, we actually started the CVC Insider community and event series as an effort to build a more stronger, more supportive ecosystem for startups, corporates, and investors alike. So if you would like to connect with our community of over 1,000 investors from around the world, please feel free to shoot me an email that I'm now going to be dropping into the chat. And every 2 weeks, we're hosting this roundtable featuring some of the world's top corporate venturing practitioners and sharing their unique journey into CVC, some of the challenges that they face along the way, and some of the best practices that they've gained accordingly. So if you or somebody in your network would like to participate in this series, feel free to nominate them and send them our way. And so, Nicolas, I'm going to pass it on to you to moderate today's session. Please take it away and enjoy.
Thank you, Alba. And yes, I really want to encourage the audience to nominate people you think would be ideal for the CVC Insider. In this case, it was Jim Mawson from GCV who recommended Malin. And no surprise, because Malin was ranked number one in the world, a rising star for the GCV list. So clearly, we're going to learn a lot today. And Malin, if you could start maybe 5 to 10 minutes talking about your personal journey towards corporate venturing and what you're doing. Thank you.
Hi, Nicolas. Thank you so much for this opportunity. And as was mentioned previously, my background is with financial venture capital, and that's really where I started my career. So I'm an engineer by design. I was very much into the environmental issues already back in the 90s. So that's what I wanted to study. So I took a Bachelor of Science in Energy and Environmental Technology, where we actually programmed a website in 1998 where you could calculate your carbon footprint. So that was like, 22 years ago, something like that. And then I took a Master of Science and an MBA. And after a management trainee year with a large Swedish bank who was really conducting, the only big bank that was conducting venture capital operations, I just found home, right? Because I think that venture is even more about technology and technology understanding than finance. And the combination of the two really fitted my interest and background and knowledge. So, I mean, my entire career, I've been in this industry. It's been, tremendously satisfying and interesting and hard. I've invested across a number of industries. It's consumer-based products. It's B2B2C. It's B2B. It's been clean tech, fintech, legal tech, music tech. Such big brand names. Early investor in Fishbrain, for instance, the largest angler community in the world. Soundtrap, which was acquired by Spotify. And then, a lot of clean tech stories as well, good and bad. And then I'm with ABB and my first real corporate venture capital role since 3.5 years back. So, I mean, I think in general, it's more common that you perhaps move from CVC into financial venture. And I did the opposite. So I started out with the financial VC industry, and it was more by chance than really a set strategy that took me into ABB. So when I was with the Swedish tech industrial technology foundation prior to ABB, I heard from a friend's friend that ABB had this collaboration hub based out of Sweden called Syndicate. And then I thought, well, I must visit them and see maybe there is some interesting deal flow then from an industrial tech perspective. So I did, and I got to meet the team there, and I also got connected with the CEO of ABB. And then he reached out to me and said, well, Malin, why don't we do something together? And why don't we tie more together the collaboration and the startup and POC activities that we have with startups and scale-ups through Syndicate and connect that to ABB Technology Ventures. And then you could be this bridgehead, if you want, based out of Sweden. So you're very close to the Syndicate hub, but also close then to the globally spread out technology ventures team, which Grant Allen, he was leading that at the time from Silicon Valley, and we had people in India and Zurich and so forth. So that was really, it wasn't planned, but considering my technical and educational background in this environmental digitization and also energy fields, it makes a lot of sense. I think that inherently so, everything we do and we invest in has a positive impact on the environment, because the big themes that we operate with is, digitization and electrifying the world. And then you see, the themes of EVs, smart cities, smart buildings, and smart power. All that is heavily impacting positive climate effects and change. So I think in a way it's back to my core as an engineer and my love. I'm a total technology optimist. I think that we will probably have some unknown engineer somewhere in the ABB organizations probably going to do more for climate effect than any well-known politician. That's my firm belief, and I'm happy to help speed up the technology race that we are in through the engagement of startups and creating this open innovation ecosystem. Because I see venture capital and corporate venture capital as a tool in the open innovation toolbox. So for an incumbent such as ABB, I think in order to engage and have the speed and be comfortable with the risk taking, I think that VC is a great tool to do just that. So and coming from the financial end, I need to learn some new things then from a strategic perspective, but it's also very sound to have that background, to know what constitutes a good company, a good team from a financial perspective, because a financially sound company is going to be a sound company in general. So it's super important that those pieces are in place. And then you add on the technology side. But as a good investor, I don't think that since the investment theme is so wide, you cannot be an expert in each technology, in each industry. You have to be a generalist, but you need to be a specialist in how to grow companies. And you don't become a specialist unless you've been through at least one cycle. So you have to be there from, the investment through the growth, out to the exit at least once, right? And preferably twice or 3 times around, right? So I think the experience from financial VC is really a very nice, competence to have, and which can then be also exported out to ABB and the ABB organization in a sense. So educating and helping to understand the value that VC brings and how you can be some kind of translator in a way between the big mothership and the startup, right? So that you understand both sides, you understand how they reason, their different clock frequencies, their risk appetite, and how you can bridge these two. So there is a win-win situation, because that's also something when we do investments, either it works out, so we have a value creation through an engagement together, or it fails. So it's either a win-win or a lose-lose. It's never a win-lose type of situation. So trying to get ABB and the startups in the same boat. So yeah, that's a short version.
Thank you, Malin. I think it's really nice journey you took, and I want to touch on something. There is a thread I can see about the engineering and the technology. First, you have an engineering background. You mentioned you're technology optimist, which I think is what we need, especially when we are investing in entrepreneurs. We really need to have that optimism. It's of course important to see all the things that can go wrong, but you want to see if everything goes right, the impact it could have. And there is one thing you said, which I really love. You said, I'm sure there is someone, an engineer somewhere in ABB that could have more impact than all these politicians. Can you tell me how you work on making sure that this innovation that you're exposed to could influence that one engineer in ABB that could then be empowered to actually create this transformation?
Exactly. So what is it that we have to fight here, right? So you have the notion of the not invented here. You have a background of very process control type of setups, which makes sense from one perspective, but it also inhibits the speed of innovation and how you get to market. And it's, as a technology optimist, but it's not just the technology that makes or breaks if you're a winner or not, right? It's also about the business models, execution, your ability to be nimble and do pivots and be fine with that. I'd rather invest in a B technology with an A team than the A technology with the B team. I've seen this so many times. And then coming back to your question, how do we get the engineers with ABB to understand the value that engineers from outside, right, and the entrepreneurs bring? So I try, and many times venture capital is seen as a very risky operation, right? So the odds are against you all the time, especially when you're doing early stage. The odds of you succeeding are high, right? So it's hard. But the alternative of investing in technology from that perspective is to do your internal R&D. And with the internal R&D money and the project, then it's 100% ABB money. But with the startup, then maybe we capitalize with what, 20%, something like that. And under the ABB umbrella, not willing to take the risks, entering into new market segments with a bit more unproven technology and such, we can then collaborate with the startup who is willing to take that risk and who is not bound by stuff that really slows them down. So it's a way of engaging and testing out and getting, a lot of knowledge, insights, and help to your own R&D situation or sales team or whatever it is through that engagement. So, I mean, ABB comes from a hardware heritage, and our absolute main slice or part of revenues and profits come from hardware devices. So, and we have been doing stellar stuff, but now we also need to translate that and keep doing that on the software side, which doesn't come overnight. And one way of doing that and trying to expand and expand also our hardware into software components, right, and new business models, is to engage with the already more knowledgeable, more out there kind of teams. So I see this, that's a story. I mean, and then you can have these KPIs in terms of revenue generation, speed to market, acquisition targets and such, right? And that's different on case by case. But the fundamentals is this, that in order to collaborate, you get this opportunity to test out, to try, and you don't bear the risk on your own. So and it's harder to say no once you've met people. So try and getting not physical anymore, but at least like this, then video calls, interacting beyond the emails. right? And beyond the slide decks. That's how you get people, collaborative and getting to know each other on a personal level. And that's very crucial. And then also, from a CVC perspective, how do you really get the transformation done? You need to find the ambassadors from within. So you need to find the people who have an understanding, a willingness, and also the power to actually make this happen. And you need to collect them. So you have them in your team, but you also have them in different parts of the organization. So you just keep you on building your herd of good, energy-like people. So,
okay, that I think touched on something really important.
Yeah.
Which are these ambassadors or champions? How do you cultivate them? How do you motivate them? How do you get them started to want to be involved?
From within ABB?
Yes.
Yeah. I think in general, first, there is a growing notion about this concept. I saw a number of years ago, maybe it's more now, but 75 out of the Fortune 100 companies have their own CVC teams. And I think like every third dollar now comes from CVC in the VC market. Now it's skewed by SoftBank, of course, and their huge funds. But yeah, but still, and there is a clear and very consistent trend, and companies with CVC teams outperform the stock market. Now, cause and effect, right? But still, there's a very clear correlation there. So I think there is a general apprehension of this open innovation culture, that this is something that from top management is considered, more and more important. And I think as CVC, as a part of the open innovation, as I said before. So cultivating the ecosystem. So in general, and by management, I think there is a growing acceptance and understanding of this. And then there is, I think it's a question of educating, of involving. So for instance, we have begun arranging hackathons, so hackathon events. In all these hackathons, we involve the divisions from day one. So they say, okay, what is your need? What would you like solved? How would a successful POC look? Which type of companies do you want to engage with? So everything comes from their needs. So it's very much inbound to my team. What are they looking for? Instead of more pushing, like just hitting out, a pitch deck after pitch deck. I mean, we get, I don't know, maybe we see 2,000 per year, and then it makes no sense for us to push it, because then they get overwhelmed. But when we curate based on their needs, I think you have a very nice dynamic. So we come from the understanding from a startup perspective what constitutes a good investment opportunity when it comes to how does the cap table look, what is the experience of the management team, Syndicate, stuff like that, right? And capital needs that make sense, like maybe not wave power infrastructure projects make sense to invest in, right? So we can take that part, but on the technology, application, business model side, then the divisions need to be the judges. So yeah, that's how we cooperate and collaborate on this.
Very nice. And something you mentioned earlier on was when the CEO of ABB was talking to you about joining, he talked about POC. So clearly this approach of being very practical and engaging very early on the teams inside ABB probably came from the top. Can you... No? Okay, so please explain that.
No, so similarly, I mean, we have different initiatives from different parts of ABB. And similarly was more of a grassroots kind of initiative. With their own brand, their own website, and it has proven to be very successful because they build a sense of trust and a sense of we're here to add value to you, to the startups. So everything comes from a perspective: how can we help? How can we provide value? Easier legislative formats. infrastructure, settings, onboarding systems, collaboration between the startups themselves, sorry, direct connections, helping startups to find people in ABB. I mean, if you don't know the organization, where do you turn to? Do you email info@abb.com, or what do you do? So it's been an ambition and an operation that has really over time proven itself. So it was not driven from the top, actually, but of course it's very much approved and appreciated from the top. But it was an initiative closer to the market, actually, from the start. Yeah.
So part of the audience are people who want to go into corporate venturing. Maybe they're thinking about how to create a corporate VC in the organization. Can you talk about some of the best practices, but also maybe the pitfalls of having this grassroots initiative? What worked? What you think is something you would say to this audience? Watch out for these parts.
There are very good books and reports on what constitutes best practice in CVC. One of the major things is where does it belong in the organization? So when you see successful CVC teams and strategies, then they usually lie under the CEO or the strategy officer and not under the CTO, right? It's not a technically something R&D correlated type business. It's not. So that's the first one. Yep. Where in the organization do you lie? And then I think it's important to have the right mandate and the commitment over time. It's never a sprint. This is a marathon. And we're going to lose money and we're going to gain money. We're going to have companies that don't succeed in generating strategic value. And we're going to have those that will. And it's going to take time to single out which are the winners and which are not. So I think a commitment in time is super important. And then you need to have the horizon focus more aligned with the startup than with a quarterly reporting type public company, right? Because this, as you know, this takes time, especially then when it's very tech driven, B2B focused or industrial. It takes time. So those are, and then of course the sizable amount of capital committed, because also building a successful portfolio, and also if you look at financial return, it's a numbers game, right? Mm-hmm. So you're going to need your number of companies, whether it's 15, 20, 25. So those are some of the key things. And also I believe that if you don't have experience in VC as a corporation, hire people who have, whether it's financial VC or CVC from somewhere else, but it's very particular. And it's not the people you usually find perhaps in your organization. And then you can complete the team with people from within, with technical background or sales background or whatever, right? So that's some major points.
Thank you. And what would you say is a good golden ratio between external people that bring skills you may not have internally and internal teams?
I don't have a golden ratio on that one. I think that it's always a bit dangerous, whether you're talking about competence or, you know, minority representatives or whatever, to have one, because that's more of an odd one out than actually, you know, getting the experience of you put forward. So I think at least two. But then it depends on how big the team is and who is on, and whatever you find the experience from inside. I don't know exactly how that could.
I like your analogy of marathon. It feels like it's sprints after sprints after sprints, but it's really a long-term engagement. Maybe you can describe a little the size of.
I mean, I would also say that. I mean, that's one of the strong the USPs of a CVC, right? We are usually evergreen structures. Sometimes we're not, but we usually are. And if you have the long-term commitment, that's a very strong sales argument, especially to serial entrepreneurs who have maybe had the experience of getting funding from a fund that was later stage and where you had to liquidate quite soon, and the trap that it puts you in as a founder, as an entrepreneur. So just a comment.
So Malin, I'm going to triple click on this one because we never touched on the concept of Evergreen Fund in the last 17 interviews.
All right.
What do you think I mean, clearly I understand the long-term commitment and this is a really nice discipline, but what do you think are the reasons why someone would want to do an Evergreen Fund versus a structured Fund 1, Fund 2, Fund 3?
So either you, as we do, we invest directly from the balance sheet. So we don't have a standalone fund structure, and people working with venture are just employed by ABB. So that's a setup that has been, in ABB since we started 2009. And it's still there now with EL Electrification setting up their own ventures team. I think it's very common practice, but then some people choose to have a standalone fund with perhaps more of a standalone also investment mandate, an investment committee. And then it's more similar to the financial VC side. The advantages of the standalone fund is that it's hard to divest because the money is kept, right? That might be easier with the balance sheet operations because you can from one year to another say, no, we're not going to do this anymore. And then you just, but from an investment perspective, with my previous fund, which was set up as an evergreen and a foundation, the staying power you have can be very valuable. So that fund, for instance, did Oatly. I don't know if you know the oat milk brand.
Yes.
Which was then, I think they held it for 14 years, which would never happen in a vintage fund, right? Because you have to get out. And I saw a number on financial VC structures. I think it was like 5% who was liquidated after the 10 years, not more. So it takes longer time than you think, also in consumer products, but especially when you have industrial applications as we do. There are pros and cons with both, but there is, I think it's important to press on the advantages of the evergreen, especially in our business. And also when you look at the trend also of clean tech investments, which usually take even more time. If you have these larger installations, you have legislation that you have to adhere to. So it takes a lot of time. I saw from Quorum, the average age of an acquisition target in the tech sector, whatever that is, in Europe is 14 years. That's the average. So
I wonder actually, because ABB, your electrification and industrial and hardware, all of that takes much longer than if you were investing in software or internet. And I wonder if actually the evergreen setup is better fitted when you actually need this long-term patience investment.
I mean, I would, if one could choose, I would perhaps choose a vintage structure, but with a longer lifetime. But the problem is that you don't get the LPs to commit. The LPs already think that 10 years is a very long time. And if you would ask for 15 or 20 years, you would have a very hard time finding the capital. So then the alternative is an evergreen structure. And you have those types also, especially in foundations, right? It's usually evergreen structures. And yes, I think B2B, industrial, deep tech type of companies, combine that with doing the disruptive, high-tech, early stage type, then you're in for the long run. So for instance, we did an investment in a graphene company. So that's material science, right? So material science comes from research at a university, and then you need to, go outside of the lab, and you need to build your own pilot production facility, and then you need to go to clients, and they need to test it out, change their procedures, design it into components that then have to be designed into products and then have to be sold, yada yada. A long time.
Long time.
Just one example. Long time.
One thing you said earlier was you have KPIs per investment. And so I think the time you think a material science company will take versus a robotics company that already has a product will be very different. Can you talk us through how you define the KPIs? Is it just before the investment decision? Is it after the investment decisions? Is it during the due diligence? How do you define these KPIs and why do you make them so different per investment?
So there is no set library of KPIs. We don't have that. But so I've been looking into this quite a bit, and you can segment it into qualitative and quantitative. And so the quantitative ones are, of course, easiest. So you can have your IRR or your multiple or your revenue generation or whatever, right? Yep. And then you have the qualitative ones, and those are harder. It can be about knowledge exploration, knowledge increase, maybe speed then to market. It can be a more agile way of working, etc., etc. And I think that each case that we bring and that we invest in, we do have an idea of what's the value that we want to create. And we define that through an engagement plan and a rationale. So where is ABB now? What's our need now? Or what's our need in 5 or 10 years? What can this startup and the technology itself help us do? And that can be, as we said before, that could be sales or market access or customer insights or whatever. But it's very much on a case-by-case basis, and the final reporting is not as much in a table format with KPIs as much as showing, evidence of this is what we've been doing, this is the results, it worked out, it's not working out, and such. You can do that if you don't have too many investments. You can still go and report that way. But I think in general, it would be beneficial for corporations to find a set of KPIs that matter to them. I saw one report because I wanted to compare the outcome of internal R&D with venturing. And I found one report that actually showed that when it comes to efficiency measured by patents, VC money was 6 to 7 times more efficient than internal R&D, which is quite interesting.
This is really a big difference. Actually, if you can share the report link, we will add it.
Yeah, I shared it on LinkedIn like 2 years ago, but I can see if I find it.
So one thing I liked about what you're describing is you're very clear about the value you want to add to the startup, but also to the mothership at the time of investment. Over time, maybe the mothership start changing strategy or divest like you've done with Hitachi, or the startups might pivot and therefore what you expected to deliver is very different. How do you track this and how do you message these changes over time?
So first, that's absolutely fine. So everyone must agree that it's fine, right? It's fine. We can lose our money. We can gain absolutely zero strategic value. That has to be fine, right? And we don't want to enforce, and we don't want to, cage startups. They are their own companies, and ABB is our own. We're not talking about the pre-acquisition type of operations here. It's 2 standalone companies. And yes, ABB changes. People leave, people join. We do divest, right? We sell or spin off, or we initiate new segments in new markets. And so does the startup. And that's absolutely fine. We're just saying that at the time of the investment, a mutual engagement plan has to be in place. Now, it's not a legally binding document, but it's kind of a strategic ownership agenda, as you might also have a financial ownership agenda, and you agree on it, and you want to have it in writing because it's so easy to misinterpret each other, and you say, oh, we agreed on this. No, I thought we meant X, and someone says, no, I meant Y. So that's very important, and we see as we go. And that's also a part of the strategic value, I think, that ABB can gain from interacting with the startups. That we find out that this market is really hard and the profitability is really low, right? Okay, fine. Lesson learned, we don't enter. Or it's the opposite, right? That this company, they were right. So it's gonna be robotics as a service, or it's gonna be graphene that changes like everything that we do with the electricity leading plastics, right? So and that's fine. I mean, I know our former CTO, he said we did a horrible investment in a photovoltaics company, and he said it was the best investment because one of our competitors ran off and bought a PV company for billions, right? And we just did a small VC investment, and it showed out to be a disaster. So lesson learned, right? So dipping our toes in that water. And also as a CVC, you do have the power to make your investment a winning horse, right? Because the promise that we bring is that our dollar is worth more than a financial dollar. If we can help startups with reducing time to market, reducing risks of failed product development, if we can get them access to our researchers, to our salespeople, everything around this that helps them speed up faster and do fewer mistakes, because that's what venture money is for, right? Affording to hire the wrong people and the right people, making the mistakes, and growing. If we can help them in doing that in a smarter way, then I think we are adding the value that we promise. And that's also the hard part, right? The engagement going forward, but it's also very enticing, and that's what I'm saying with a win-win or a lose-lose situation.
So there are many golden nuggets. I think there are three which I will take away right now. One is, I think it's very important to have this in writing, like you mentioned, what it is that we believe with the startup, with the entrepreneurs, with the mothership, what value can be added. I love the second golden nugget is things will change, it is fine. And I think the way you described it with no hesitation was extremely compelling to me. And the third one you mentioned, which I think is the one that's very difficult to measure, because you can't measure something that did not happen, but which clearly is extremely valuable, is avoiding big, costly mistakes. Like learning not to go into a very expensive acquisition in a place you shouldn't go. So it's really, really big. I want to triple click on your win-lose, because you said it's only win-win or lose-lose. There is no win-lose.
Yeah.
I want you to describe more of that.
So either we succeed in the cliche of 1 + 1 = 3, or the engagement plan just falls flat. And so the promise that we bring, beside the capital, right, the value that the startups that want us as an investor see, if we can't deliver that, it's a lose for them, and it's a lose for us, right? So we did not make this a winning horse, and we did not execute the way we planned. So it's never the case, that, I mean, we always operate with very clean terms and clean agreements, because we want to syndicate in deals. So we want to be treated as any other investor on the cap table, no ROFRs or exclusivity rights and stuff like that. And if we don't generate the strategic value for us, we don't help the company also from a financial perspective, because it's very connected, right? If we can help from our perspective, then it results in financial gain for everyone, right? And it's important. I always try and put ourselves in the same boat as the entrepreneurs. I try to construct agreements so that we have the same, the entry valuations are of course different, but so that we have a similar way of the road towards profit, right, if you want. So trying to keep it as simple as possible, I think that's very important as well, so you're in the same boat, as well as your co-investors, of course.
Very nice. Actually, I think you're giving a new level of granularity, which I think now I understand what you mean by win-win or lose-lose, which is you win with the entrepreneur or you lose with the entrepreneur. And by you, I mean the corporate VC. But in the case of avoiding a very costly mistake, it's actually a win for the mothership and a lose-lose for the corporate VC and the entrepreneur.
Well, financially it was a lose-lose, right?
Exactly.
The insights was valuable. I agree on that. One of my favorite theories, it's not theory, it's reality, is this of innovation disruption. You know that, of course.
Yep.
So that comes from Harvard Business School, right?
Yep.
And that concept happens all the time. So for every company, all the time. And I mean, in the ABBs up here, we have these great technologies. We have an attractive customer segment. We try and, getting the margins higher with whistles and bells. And then comes someone from underneath with just, adapting the new technologies, having a factor 10 on decreasing costs, and that just eats you the way into, less attractive market segments, and sooner or later they are there against you, right?
Innovators dilemma.
And that's what I think that corporations need to realize, and offsetting that risk through the startups, because they actually constitute the threat, right? So having them as your ally instead, and trying to gain the values from experience in a very nice ecosystem type of reality, I think that's very important. So not looking at the startup as a competitor, because yes, there are companies that can create their own ecosystem, like Apple or maybe Google, but ABB won't, right? And most of us won't. So how do we then make sure that we are relevant in the next decade and the decade after that and so forth? And then I think you have to be in an ecosystem of winners. That's the key. So you have to bring stuff to the table, and you have to have the winning horses around you. They are not your enemies, they're your allies. That's how I see it.
That's a really good way to explain it. And in a way, it touched also on what you said about the R&D, who have to also make bets, but they can't go too high in risk either.
Yeah.
And therefore, you could see the R&D and the corporate VC as real allies. Corporate VCs can make way more bets, less costly in many more places, where the risk is much higher than the R&D can afford.
Correct. And that's also, is research being done also, on this golden ratio. I don't know if you know of it.
Oh, we are back to the golden ratio now.
Yeah, and it's amazing. And that's what you're saying as well, that internal R&D tends to be in very adjacent to current business. The moonshots are not really there, right? And it's more about D than R, I would say. It's heavier on product development than actual research in general. And so for the moonshots, how do you get access to that? How do you master going then into, also, of course, for ABB, we have so much requirements on cybersecurity and SLAs, and the things really have to work 24/7. So we need, of course, to operate in a safe zone in a way, right? But it's also critical that we move forward with a certain speed. So then we need to partner up. That's how I see it.
Very nice.
And the risk for us, the risk could be that we divert with some half percentage in the gross margin, right? But the risk for the entrepreneur is that he's going to lose his house, his wife, his dog, and he's fine with that. So, yeah.
Yeah, no, agreed. You talk about partnerships, so let's talk about Syndicate. And here I want to ask about your general approach to Syndicate, but also what happens when actually one of your KPI is a potential acquisition of that startup, because that creates a different dynamic with a Syndicate potentially.
Yeah. So we almost always syndicate. We almost always co-invest with other players. It's our frenemies in the market. We co-invest with the Eaton and Siemens and Schneider, but we also do so with financial players, angels, institutions, So we're all over the place. We think that having a dynamic of more parties than one with the deeper pockets in the boardroom makes a lot of sense, and it's better for everyone involved, and it's also a way of not labeling the company an ABB company. So it's valuable for the startup as well. As you rightfully point out, this is also a question that the entrepreneurs have because they don't want to limit the exit window. Makes total sense again. And we don't operate, as I said before, with ROFRs. We want to be able to be part of a bidding process, yes, but we don't expect companies or co-investors to write in special conditions in any agreements whatsoever. So market price, right? If there is an auction, then we want to be able to bid.
Yeah.
But that's it. Yeah, that's it.
Yeah, so you would want to know about it, you would want to be able to get into it, but you wouldn't be asking for special rights to give you a lower price, which would not be good for the syndicate.
No, never. And I mean, to be honest, the best companies, entrepreneurs, investors would never agree on it. So it's more important, I think, to get access to the best companies than having some special rights. And in the past, actually, we've acquired 10% of our companies. So 90% of them have gone on to trade sales or IPOs. So it's a smaller amount. It's happening, but it's a smaller amount.
Yeah, I think it's a golden nugget you're just describing, which is don't ask for terms that are not good for the entrepreneurs and for the syndicate. That actually gives you the wrong starting point for a partnership.
Yeah, and it's always about trust. I think everyone is in a good mood before an investment is done, right? Everyone is showing off their good sides, but then comes the work during the marathon, and you need to be able to have a constructive cooperation, even though it's going to be hard times. And then if you feel that the negotiation was not a win-win, but a win, uneven from start, it's not a good starting point. So everyone needs to be dissatisfied on the same level when they are signing the agreements, right?
Equally satisfied or equally
dissatisfied. Equally dissatisfied, correct.
But this is what partnership is about. So I totally understand your point. I want to touch on something you mentioned also. I like the way you phrased it, which was combination of technology and finance. Now, many people ask these questions, are you strategic or are you financial? I hate that question, so I'm not going to ask that question, but how do you reconcile the strategic imperatives that you want to address with a financial discipline of good VC type returns?
So we are first and foremost a strategic investor. I would also say that some investments are more strategic than others. So there is, the compartments here. So take the graphene company. ABB is never going to be a material science company, right? So for us, that is not as core. So we are less of a strategic investor. So we do a lot of collaborations with them, but it's not very close to the core. Compare that to, if you're looking at grid management companies or robotics companies and such, which are more closer, then it gets a bit more, sensitive. It has to be managed in a very good way. And so we need to tick that box first. We need to tick the strategic box first, which is usually what takes time. And that's why it's very nice to have hackathon events, collaboration units, getting the feel for one another, getting into projects, maybe going to market together, whatever it is. So we, having coffee by the coffee machine, or a virtual coffee now, perhaps, beforehand, before going into the investment. And that's also, sometimes ABB are a bit slow in finding that alignment. So my recommendation for startups that are looking for funding for us, come in good time before the actual fundraising is starting, because we do need some time to find the strategic fit and the ambassadors and such. And then we, from the venture team, also tick the financial box. So CVC in the past was seen, a bit as, stupid money, right? But I always like to have commercially sound terms. I always negotiate. I always want to see a sound financial investment. Yes, I do. But then, we're in Evergreen, we have staying power. It's very hard to decide whether you throw good money off the bat or if it's, a good decision to give the company more time, etc., etc. But that's the reality of any investor, even financial ones. And I mean, to be honest as well, as a big incumbent, even if I do 10 times the money on an investment, the strategic impact might be so huge, right, for the ABB $1 billion operations. So yes, that might have a larger impact than a financial gain.
Well, you could argue the 10x on your investment will not move the needle for ABB, but yeah.
Yeah, that's reality, and that's the reality for most CVCs, I think.
Yeah. Now you mentioned commercial terms. Does it mean that you always want commercial terms between ABB and the startups for investment, or it's not, or it's a soft requirement, or it's not a requirement?
Well, I was thinking about the commercial terms in the financial agreements.
Okay, understood.
On the commercial side, on the operational side, we don't need to have a formal LOI or partnership agreement and such in place. Okay. We don't. No. But I want the engagement plan. I want the idea, the vision, the energy and the willingness to cooperate. That's what I want, because you can't enforce that. So there must be a realization of potential value creation from start. That's what I want. Yeah.
Very nice. And maybe one way to really understand how this works when you make an investment decision is who is in your investment committee and what do they care about?
So I'm now with the electrification business area of ABB. So that constitutes now half of ABB. We are approximately 55,000 employees. And we make our own decisions. So it's sponsored by up to a certain level in size, ticket size. We take our own decisions on a president level. And it's on a very flexible way of working. We don't have set fixed dates like every other month and such. We do it on a case-by-case basis. We try and find, the commitment and the yes from the president prior to starting any deep due diligence of the company. So we're trying to make, as much groundwork as possible to make sure that once you reach the stage of a term sheet, the odds of making the investments is very good, right? So there is very little stuff that falls out unless you find red flags during the due diligence, but you will conduct the investments on a very high percentage of the times. So that's how we operate. It's really quite, in that sense, it's very efficient.
In a way, it sounds like a financial VC, but when the check size start to be higher, then what happens?
You have to go up to the bigger guys.
And at that point,
the president of the EL.
At that point, what do they care about? What would be the reason they say no, and why would they approve?
So again, we need to make our homework, right, and the groundwork before you even go there. So you need to have your story in place, really good. But I would argue that the CEO of electrification, Tarak, he's very do-it-oriented. He's very much into action, right? So if you come with the logical story, with the proof points and stuff, then he's all positive. So again, back to how do you succeed in doing the CVCs, right? You have to have buy-in from top management. So I think his perspective on this is that it's really important and that he's committed and he sees the value. But you have to prove the value to him. So you cannot come with a problem and just a question. You need to have a solution, right? And a suggestion on, okay, this is how I would like to do it. But it's also on a case-by-case basis. It's also very agile. So yes.
And how quick are you to make investment decisions?
As I said, it's a strategic part first that takes time. And then after that, it's as fast as any other investor. So the due diligence process, the negotiation, can take, I'm actually looking into one company now, and I think 3 weeks, but then it can take a year as well. right? If you have the POCs and you have technology and you need to iterate and try it out and such. So,
very nice. We're getting to the
yeah.
top of the hour, but I want to ask a question about something you said, which was very interesting. You said you need to have specialists in growing company in the team. How do you find these people? Because are you looking at people who did startups before, or are you looking at people who were on board of companies that helped the company grow and be successful? What are you looking for in this specialist in growing companies?
So when you're talking about the investment team?
Yes.
Yes. So I enjoy people who, because this is my belief. I know that there are some who say that an investment team should be consisting of entrepreneurs because they have the experience of growing companies. Yes. Or you want people who are more of investor experience, financial analyst, and that type of. And I believe that as an entrepreneur, you have a very specific personality, right? And I think as an investor, especially I'm very risk averse. I don't like risk, but I do see opportunities. And when you're trying to hedge stuff, you get very good at constructing the good investment hypothesis and identifying the opportunities because you have the devil's advocate, so you have control of stuff. And I think that the entrepreneur has to be the star of his own company or her own company. So I think, yes, sometimes you have entrepreneurs in investment teams, but it should not just be entrepreneurs, because I think you need the different types of personalities. And I want the entrepreneur, as I said, I don't want to have an investor who challenges all the time, right, from his perspective or her perspective, but I want someone to support. And from an investment perspective, with our insights and from all the capital raises that's going on and the growth and the politics from within, the mothership, you need someone to help the entrepreneur from that angle. That's perhaps how I see it. So I would rather go with this one perhaps before this one.
Very nice. So my last question is something you care about and maybe inspiring for everyone to listen to is, what do you think corporate venturing should do better to ensure that we have as much possible impact for the environment, positive impact for the environment?
I think it's a numbers game. It's a lot of money out there. We see that, I see companies in the private sector which has their own counterparty, in the public environment, and then you have an arbitrage of 10 times in the multiples. That's why you have the SPACs, right? You see this trend. I think we need more. We need more because the institutional capital is now flowing into the sector, but there are not enough companies, and that's why you have this difference.
Yep.
So I think that corporates really have the power. We do have the money, right? And we do have the channels, we have the market insights, we have the installation capacity. So I would say just do even more of what we're doing and realize the importance of time and speed. Like Elon Musk said, yeah, of course, if you work 100 hours per week instead of 40 hours per week, you get more done, right? I'm not saying that, but I'm saying that if we add hours, people, and money, we can make things happen faster. And with the muscles of the corporations, then we really speed it up. But then you need to understand that there is no really high risk in venture. The largest risk is not doing anything at all. That's a big risk.
Very nice. Malin, it's a really good way to end the interview. Thank you so much.
Thank you. Happy Easter.
Happy Easter, that's true. You didn't do the April's 1st fool's joke.
Yeah. Exactly.
Thank you.